Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree sessions in which we cover all the relevant and important finance current affairs and the RBI notifications which are important from the exam point of view. And in today's session, I have brought for you a very important report that has been recently released by the Reserve Bank of India. And this report is from a working group on the state government guarantees. So this seems a little difficult that what are these guarantees and what this working group is and why the working group has released this report. All of this we are going to discuss in today's session, and I will show you the major highlights of the report and the major data points, the factual information that you need to know from the exam point of view. So in today's session, this is going to be a very important session. This is a very important report that has been released by the Reserve Bank of India. So let's get the complete and holistic understanding of this report. Let's start with the session, but before that, do subscribe to the YouTube channel and join our Telegram channel for the PDF of this session. Okay, so you will get the PDF of this session in the Telegram channel. The link for the Telegram channel is in the description box below. So let's get started with this. A report has been released by the Reserve Bank of India. It has been called for. So under the report, there is the information that the fresh caps on the guarantees are required. Okay, that is required for the project loans that are facilitated and this is important for the better fiscal management by the state government. So this is a very typical line that I can say. So we will understand that what this line is trying to say. So the report of the working group has been released on the state government guarantees, and the report of the working group, it has said that we need to put the maximum caps on the guarantees that the state governments are providing. The cap is required, or the maximum limit is required on the guarantees that the state government is providing, because to facilitate the better fiscal management by the state government, so that they are better managing their financial system. Okay, so states loan guarantee more than triple since financial year 2017. So you can understand that this is a very big problem. What are the guarantees? Let's understand them. So guarantee is a type of potential liability on the state government. Okay, like your brother wants to take a loan and you are going as a guarantor for your brother or for your friend, let's say, and that friend runs away. So you will have to pay the loan. You can understand that your friend is taking the loan and you are a guarantor. Now if the friend runs away, you will have to pay the loan. Similarly, the state government is becoming a guarantor in many of the loans that are being taken by the public sector enterprises under the state, as well as cooperative institutions, the urban local bodies. If they are taking the loans, the state government is becoming the guarantor. Let's say that the public sector enterprises makes a lot of loss and is not able to pay back the loan. Then the state government will have to pay the loan on behalf of this public sector enterprises. Okay. So this is the idea that the state governments often issue guarantees on behalf of various public sector enterprises, cooperative institutions, urban local bodies, etc. to various banks, financial institutions. So the guarantees are provided to the banks from which the loan is taken, financial institutions from which the loan is taken, and the state government is working as a guarantor. Often a government guarantee makes it easier for such entities such as the public sector enterprises, cooperative institutions to get easier loans in good terms and conditions. So this is the whole idea, that the state government is giving too much of the guarantees. Okay. So here you can see that the state's loan guarantee is more than triples since financial year 2017 to rupees 9.4 lakh crore in financial year 2023. So this is a very big problem, that the state guarantees are increasing very rapidly. Now just think that what if many of the public sector enterprises, many of the cooperative institutions, they are not able to give back the loans, then the state government will have to give that loan. Then the state government will have to take the burden, and this will be a very big problem on the fiscal system of the state governments. So the public sector enterprises, yes, they are under the state government, but let's say that the public sector enterprises is taking the loan. Okay, is taking the loan. Now the public sector enterprises, this enterprises has to pay the loan. It's not the state government directly that is paying the loan. Okay, public sector enterprises or the cooperative institutions or the urban local bodies, they have to pay the loan. Now, if the state is giving, like the burden is on the public sector enterprise, that the public sector enterprise, if it is not able to pay back the loan, the public sector enterprises will have to be sold, or some asset will have to be sold that is under the public sector enterprise. If it is not able to pay back the loan, the direct burden is on the state government. Indirectly, not indirectly, but directly the burden is going on the state government. If the state government is not working as a guarantor, the burden will be on the public sector enterprise. It can do anything to pay back the loan, or it can increase the timeline or something. Okay, it's not always that the state governments have to come forward to pay the loans of the public sector enterprises, only when it is working as a guarantor. Okay, so this is the idea. And it is not only becoming the guarantor for the public sector enterprises, but also the cooperative institutions for the urban local bodies and such and such. So you can understand that the public sector enterprises that have the state government as a guarantor, they are becoming complacent, they are becoming inefficient, they are not managing their loans properly because they know that directly the state government is the guarantor. They can become complacent and do not pay the loan. They will keep their assets, they will not sell it or anything, they will not pay it directly. So this is the idea of the guarantee. It is a potential liability, it is not a direct liability because the state government has not taken a loan directly. It is a potential liability on the state government that is protecting the bank or the financial institution, that is the lender or the investor, from the risk of default by the borrower. Okay, so the state government here is directly liable now. It has the potential liability. A contract of guarantee. So now what is the contract of guarantee? It is defined in the Indian Contracts Act 1872. Is a contract to perform the promise. Okay, it is a contract to perform the promise or discharge the liability if the of a third person. So what is happening? That the first here, there are usually three parties involved in the state government guarantees, namely the borrower, which is taking the borrowing. It can be government owned or sponsored enterprise. Okay, it can be government owned or sponsored enterprise. The guarantee provider, which is the state government, and the lender, who is also the beneficiary of the guarantee. So there are the three parties involved: the borrower, the lender, and the state government, that is the guarantor. So a contract of guarantee, it is defined as it is defined in the Indian Contracts Act 1872. It is a contract to perform the promise to give the guarantee. Like after giving the guarantee, the money has to be given or discharge the liability of a third person in case of default. If a default is happening, then the liability has to be discharged by the state government. So this is the idea. Okay. Guarantees while not being harmful in good times. In the good times, the public sector enterprises is earning lots of profit, is able to pay back the interest, is able to pay back the EMIs, or is able to pay the EMIs. But during the bad times, what will happen? That a lot of pressure will come on the state governments directly. So guarantees, while not being harmful in good times, may lead to significant fiscal risk and may burden the state finances directly, leading to a large unanticipated cash outflows, because the state governments, they have given the guarantees, they expect the public sector enterprises, the cooperative institutions, the urban local bodies to directly give the loans. So the state governments are giving the guarantees on the image kind of thing, on the assumption that the entities, the borrowers, will give back the loan. But what if suddenly there is a large amount of loans that are not being paid back, in which the state government is the guarantor? So in that case, this is the unanticipated cash outflow, that is the government as a guarantor will have to give the loan back. Okay, so that will create a large unanticipated cash outflows and the increased debt of the state government, because then the state government will become the direct liability holder. These are the risks to state governments owing to the large outstanding debt and the losses of the public sector enterprises. So they are already large like debt holder, and they are already the loss makers. So it can become very troublesome for the state governments as they become. The liability will directly downfall on the state governments. It will not be considered a liability of a public sector enterprise. Now, if a public sector enterprise is not paying the loan back, it will be considered a direct liability of the state government. State government will have to give back the loan by any means. So this is the idea. I hope you have understood this idea clearly. This is the definition of the guarantee that you needed to understand. Now, as upfront cash payment is usually not required, see what is happening, why the state governments are giving so much of the guarantees. First of all, they are not considering the risk of the large unanticipated cash flow outflows. They are just because directly cash payment is usually not required upfront from the state government. So they are becoming very relaxed. In case of guarantees, there is no upfront cash payment that is required. That may be one of the reasons why the state government guarantees have increased very recklessly in the recent times. That should not happen. The state governments have to be careful when they are giving the guarantees, because if the public sector enterprise is not able to give the loan back, the direct liability will downfall on the state governments, and the state governments will be considered as the defaulter if they are not paying the loan back. Yes, the state governments, they somehow own the public sector enterprises. So they can sell the assets, but the state governments usually do not do so, because I hope you remember, I hope you know that every year a budget has to be released by the central government and the state governments. In that budget, the disinvestment limit has to be mentioned, and which entities will be disinvested, that has to be mentioned. So it is not a very that has to be approved and so. Okay. Now coming to the Reserve Bank holds now the background that we have understood about the guarantee. But how this report has been released by the working group on the state government guarantees. Okay, how this report has been released, when this working group was being made, when was it made? Okay, so the 32nd conference of the state finance secretaries, it was held in Mumbai on July 7, 2022. In this conference, it was decided that a working group will be made that will provide the recommendations on the state government guarantees. So during the 32nd conference of the state finance secretaries, it was decided to constitute a working group comprising of members that are drawn from the Ministry of Finance, Government of India, Comptroller and Auditor General of India, and the some of the state governments. So from this, the people will be drawn out, and they will be the working group that will provide the report that will consist of the recommendations for the state government's guarantees. Okay. So the terms of reference that were given to the working group, that on these reference points, the working group should be providing the recommendations. So these were to identify different kind of guarantees that are provided by the state government. Sometimes the state government also gives guarantees for the public sector enterprises, which is a public-private partnership. So this can become a little problematic, because here the private entity is also holding shares, and the private entity can also default. Okay. So different kinds of guarantees that are provided by the state government, the guarantee-like instruments. If it is not a direct guarantee, but a guarantee-like instruments should also be included under the guarantee definition by the states, and recommend a reporting or classification or dissemination framework for the same. There is one more problem that happens in the case of the guarantee, that the guarantees are not shown under the budget by the state government. The state government does not show the guarantees that the state government has given as a debt liability under the budget that it releases, that the state government releases. So it can be problematic. First of all, so I hope you have understood this, that the term of reference was that first of all define different kinds of guarantee, identify the different kind of guarantee or guarantee-like instruments, and recommend the reporting or classification or dissemination framework for the same, that how the states will be disseminating the information, that how much guarantees it has provided, to examine the existing framework for the state government guarantees and the possibility of prescribing a uniform guarantee ceiling for all the states, that there should be a ceiling, the maximum guarantees that the state governments can provide for all the state governments, there should be a maximum ceiling. To analyze increasing dependence of the state governments on the bank finance. So this also has to be told, as well as to analyze the risk of the bank to the banking sector also, because the state governments, it is said in the coming slides that the state governments can also default. In that case, the bank will be, because the banks, they are blindly trusting the state governments usually. So if the state government defaults, and if the state government is not able to accumulate most of the resources you can understand that, let's say, many of the public sector enterprises, many of the entities that have got the guarantees from the state government, if they are defaulting together, the pressure is going to come on the state governments, and the assets, they cannot be sold very easily. If you want to sell your land today, can it be sold on one day, 2 days? No, it will require some time to sell a big asset. To sell a factory, it requires months of the time. So assets cannot be sold so easily or in a very fast manner. So the state government will have a lot of pressure. The state governments usually do not have that much of the resources with themselves, and they can also default. So to analyze the risk of to the banking sector and the fiscal health of the states in view of large issuances of such guarantees that they are doing blindly, okay, to assess the adequacy of states' contribution to the guarantee redemption fund. So there is the guarantee redemption fund that has been created previously. Now how much the states adequately transferring the fund to the redemption fund that can be used. Now this is the fund that can be used during the troublesome situation, that we will understand. So these are the terms of reference that have been given by the to the working group, and the working group had to provide the recommendations for these terms of reference. Now the working group has brought out the report, and the recommendations have been passed by the working group, that these are the recommendations that the state government should follow. Understanding the point? Give me a thumbs up if till now everything is very much clear. I hope everything is very much clear till now. If there is any confusion, you can ask, okay? So this is it. Now we are going forward. We have understood the guarantee, we have understood the background. Now we are going to move forward with the recommendations that have been given by the working group. Okay. So first of all, the word guarantee. Under the recommendations, it have been written that the word guarantee should include all the instruments which create an obligation contingent, that is the dependent liability. It is not directly with the state governments, but it is a potential liability of the state government. So that is dependent liability. It will depend on the circumstances. Okay, so that is contingent liability or otherwise. Okay, so all the instruments which create an obligation, contingent liability, that is the potential liability, or otherwise they will form a part of the state government. Okay, so the word guarantee will include everything, every instrument that is creating any kind of obligation or dependent liability, potential liability for the state government. The purpose for which government guarantees are issued should be clearly defined, that what is the purpose, that why the state government is giving this guarantee. The purpose has to be told. State governments may consider fixing a ceiling. So this is the recommendation that has been given by the working group. So state governments may consider fixing a ceiling, fixing a maximum limit for the incremental guarantees that the state government is giving. That means state government has given 500 crores of the guarantee. Now in the current year, in the current financial year, the state government is thinking of giving 250 crore of liabilities, like 250 crore of guarantee further. So in total 750 crore will be the guarantees that would have been given by the state government. But what is the incremental guarantee? So 250 is the incremental guarantee. This is the increase that is happening on the guarantees in the current financial year. So it has been recommended by the working group that the state governments, they should consider fixing a ceiling for the incremental guarantee that they have issued during a year at 5% of the revenue receipts that they are getting. So I hope you have understood कि पहले in the 2022, let's say, they have given 500 crore of guarantees. Ab they are thinking, so now they are thinking that they will give the guarantees of additional 250 in the year 2023, in the financial year 2023. So in total, in the financial year 2023, the total guarantees with the state government would be 750 crore. But here we are not talking about the total guarantees. Here we are talking about the incremental guarantee, that in this current year, what is the increment that they are doing, the state governments are doing in the guarantees. Okay, so this is the idea of the incremental guarantee कि इस साल, in this year, how much increment, कितना ज़्यादा वो देने वाले हैं the guarantee. Okay, so during a year, Now it should be, the ceiling should be fixed at 5% of the revenue receipts that they are getting. So this is the idea that the incremental guarantees that is issued during a year that should be fixed at maximum 5% of the revenue receipts that the state governments are getting, or a particular state government is getting, or 0.5% of the gross state domestic product. Like the whole of the country has a gross domestic product. For the states, we have a gross states domestic product. So either it should be 5% of the whole of the revenue receipts, or the incremental guarantee should be, the limit should be 0.5% of the gross state domestic product, whichever is less. So that has to be followed. So I hope this is very important point. A direct question can come from this data point. That's why I'm focusing so much on this, that state governments, they have to consider, like this is a recommendation, so they should consider that they have to fix the ceiling, the maximum limit for the incremental guarantee, that they are going to give in a period, in a year, that should be fixed at 5% of the revenue receipts, or 0.5% of the total gross state domestic product, whichever is less. So this is a very important recommendation that has been given by the working group. It will be accepted, it will not be accepted, that will depend on the states, as well as which states accept it, which states do not accept it, that will also depend on the states. Okay, you cannot force the states, RBI cannot force the states for now. It is the states that decide for their own self. Okay. Now coming to the state governments may consider charging a minimum guarantee fee. So if they are giving the guarantee to the public sector enterprises, if they are giving the guarantee to the sponsored entities, or they are giving the guarantee for the cooperative institutions, they have to consider, like it is recommended by the working group, that they should consider charging a minimum guarantee fee, so that only those public sector enterprises or the cooperative institutions that actually require the guarantee, only they should get it. See, so what happens that sometimes for the public sector enterprises or for the cooperative institutions, if they want to get the loans at less rate, just understand that if the public sector enterprise, if you are going to a bank to get a loan, the bank will charge higher interest rate from you because you are a public sector enterprise. What if you make loss, you are not able to pay the EMIs on time? So the interest rate will be very high that is taken from you. But if you have a very strong guarantor that is very trustworthy, so the bank will lessen your interest because the risk has reduced. The risk has reduced. With the reduced risk, the interest will be charged less. So the public sector enterprise, that's why they require, sometimes they require the guarantee from the state government. Sometimes what happens that if from the bilateral institutions, from the multilateral institutions, from the IMF directly will not give the loans to the public sector enterprises or such. But if the state government is backing these enterprises, okay, if they are not able to pay, the state government is responsible to pay you back. So IMF or the multilateral institutions out there, like the ADB, the Asian Development Bank and such, they might give the loans to the public sector enterprises. So sometimes the guarantee becomes very, very important. We will understand in the coming slides also. So state governments, they should consider charging a minimum guarantee fee, that only the public sector enterprises or the cooperative institutions that actually require the guarantee, only they take the guarantee, because they will have to pay a fees also. For the guarantees that is extended by them, minimum guarantee fee should be there, as well as additional risk premium may be charged, because some public sector enterprises, they are low risk because they are profit making. Some have medium risk and some have high risk. So the high risk should be giving the higher fee. So additional risk premium has to be charged from the high risk public sector enterprises, may be charged based on the risk category, the risk category that they are in, low risk, high risk or the medium risk, and the tenure of the underlying loan. If the tenure is is long, so of course higher risk premium. If the tenure is short only, that in 1 year the public sector enterprise will give back the loan, so of course the risk premium should be less or something like this. Okay, so based on the tenure and based on where they are lying in the risk category, the minimum fee has to be charged. State governments may publish, so it is a recommendation that state governments may publish or disclose the data relating to the guarantees as per the Indian government accounting standard. So till now they are not releasing their particular information in the budget. They are not providing the information in the budget directly. So they should at least publish or disclose the data relating to the guarantees as per the Indian government accounting standards. Okay. So major recommendation, governments may be given only for, guarantees may be given only for the principal amount and the normal interest, not for the compound interest. Okay. Guarantees may not be extended for external commercial borrowings. How many of you know about the external commercial borrowings? They are the borrowings that is taken from the foreign entities. So it is the external commercial borrowing that is taken from the foreign entities. The commercial entities of our country, they are taking the loan from the foreign entities. So that is foreign commercial borrowings. For that, there should be no guarantee that should be provided. Okay. State government may not extend guarantee for more than 80% of the project loan depending on the conditions that is imposed by the lender. Okay, sometimes like I have told you that the multilateral institutions, they impose the criteria that if the PSC wants to take the loan, the public sector enterprise have to have the state guarantee, okay, state government guarantee. So as per the depending on the conditions that is imposed by the lender, the state government may not extend the guarantee for more than 80% of the project loan. No. Multilateral institutions, if we are talking about the IMF and World Bank, they are not the commercial entities. We are talking about the foreign entities that are the commercial entities. Okay. So that is why it is called external commercial borrowing. Okay. That is taken by a commercial entity from a commercial entity. Guarantees once approved shall not be transferred to any other agency. If the guarantee is given by the state governments, they have to be responsible for that guarantee without the prior approval of the finance department, or the approval is required. Government guarantees shall not be provided to private sector companies. Like I've told you that some of the governments, what they were doing, state governments, they were even providing the guarantees for the private companies or institutions. So this should not happen. Okay, that's why the guarantees were also becoming very, very risky, that they were even providing the guarantees for the private sector companies. Okay, so this should not happen. Appropriate preconditions may be specified by the government while giving the guarantees. Example, the period of the guarantee for that the state government will be giving for the loan, levy of fee to cover the risk. So yes, the minimum fees has to, like for each and every guarantee that the state government is giving, a minimum fees has to be levied by the state governments. Levy of fee to cover the risk that the state government is taking. Because you can understand that 5 public sector enterprises are taking the guarantee, or let's say 10 public sector enterprises are taking the guarantee. Only one of them can default, that also not the whole amount, the minor amount is defaulted by this. So it can be covered by the fees that is taken from all of them, okay, for the risk that the state government is taking. So this is the idea. Representation for government on the board of management of the borrowing entity. So this is a very, very big norm that has been provided, recommendation that has been provided, that for in the borrowing entity, that is public sector entity that is borrowing, that is taking the state government, in that board a representation has to happen from the government on the board of management. Mortgage or lien on its assets. So the appropriate precondition is that the mortgage, or like the state governments, so it has been recommended that the state governments can mortgage the assets also. Submission of periodic reports has to be given by the state to the state governments. Accounts to government has to be provided. Right to get its accounts audited, that is also with the state government. So these are the recommendation that has been provided by the working group, and it makes the public sector enterprises work more efficiently and be more aware about the state guarantees that is given by the state government. So purpose for which the government guarantees may be issued should be clearly defined. In line with the rule 276 of the general financial rules, you do not have to read these. Just the purpose of the guarantee has to be defined to ensure. So some of the purposes can be, so let me tell you some of the purposes. To ensure the financial viability of the projects or activities undertaken by the government entities with significant social and economic benefits. So see what happens that let's say we are building a road in our state, but that road is not financially viable. No one is going to give toll on that road. So no profit is going to come from that investment. So that is not financially viable. So on such projects, the state government should not give the loan. Okay. Let me finish this first. Okay. So purpose for which the government guarantees may be issued should be clearly defined to ensure that the financial viability of the projects are there. The projects are financially viable, just not for anything that the government is giving the loan. It is financially viable project or activities that are undertaken by the government entities with significant social and economic benefits, or it is providing significant of the social and economic benefits to the whole of the country, that the infrastructure that has been built is actually going to help the country in a very massive way. Okay, it's not like that you are building a road from the minister's house to the minister's garden and you are saying that this is the project that we have taken. So that is not financially viable, that is not socially or economically viable. Okay, to enable the state public sector entities to raise resources at lower interest rate, because I have told you that if the state governments are giving the guarantees, so the risk is less for the lenders and that's why they will charge less interest rate. Okay. So to enable the state public sector entities to raise the resources at lower interest charges or more favorable terms will be given to the borrower. To fulfill the requirement in cases where the state guarantee is a precondition for concessional loans that is taken from the bilateral or multilateral agencies to the borrowing entities. So 3 conditions that are there. पहला तो कि financial viability हो project की, economic या social benefit इतने huge हो कि financial viability नहीं भी है तभी भी चलेगा. Second precondition is that the state public sector enterprises उनको लेस इंटरेस्ट रेट पर लोन मिल रहा है या बहुत ही इजी टर्म्स एंड कंडीशन पर लोन मिल रहा है. द थर्ड कंडीशन और द थर्ड प्री कंडीशन और द पर्पस शुड बी कि कंसेशनल लोन मिले बायलेटरल या मल्टीलेटरल एजेंसी से और इनका प्री कंडीशन ये हो कि स्टेट गारंटी कंपलसरी है. Then the guarantee should be given. So these should be some of the reasons that the guarantees are being given. So someone was asking about the government representation. See, that means a member of the government should be in the board of management. So this is the idea, okay? कि government का कोई एक member part है board of management का जो borrowing entity है, that one, okay? So this is the whole of the recommendations. So now the group suggests that the state should classify the projects or activities as high risk, medium risk or low risk and assign appropriate risk weights before extended the guarantees. Such risk categorization that is happening, that the risk is high risk, medium risk or low risk, should also take into consideration past record of the defaults. Okay, so risk categorization किस basis में हो रहा है? In which basis the risk categorization is happening? On the basis of the past record of the defaults or the credit worthiness, the credit score we can say. The state should conservatively keep the lowest slab of risk weight. So the lowest risk weight should be 100%. And if you have high risk, then it should be more than 100%. If you have low risk, at least the risk weight should be 100%. Okay. Additionally, states should disclose their methodology for assigning the risk weights, in what basis they have assigned the risk weights. A minimum of 0.25% per annum may be considered as the base or minimum guarantee fee and additional risk. So this is the minimum guarantee fee and then the additional risk premium should be charged on the basis of the risk categorization. Low risk premium, medium risk, high risk premium, medium risk premium, high risk premium. So on the basis of the risk assessment, they should be given additional risk premium by the state government may be charged to each risk category of issuances. Minimum, this is the minimum percent per annum that may be considered as the base or minimum guarantee fee. So the guarantee fee should also be linked to the tenor of the underlying loan. So the implementation of the recommendations made by the working group is expected. So the recommendations that the working group has made, it is expected to facilitate better fiscal management by the state governments. Okay. Third precondition, see, sometimes what happens that IMF has said, or the multilateral agencies, the bilateral agencies, they have said that they will give loan to the public sector enterprise only when the state government is giving a guarantee. So that is the third precondition or the last precondition, that is to fulfill the requirement in cases where the state government guarantee is precondition for concessional loans. If the public sector enterprises or if the cooperative institutions they want to have the concessional loan, the state government guarantee is precondition if they are getting the loans from the multilateral agencies or the bilateral agencies. Okay, so this is easy. Any, like, if clear now, Gomti? Like, if the loan has to, concessional loan has to be taken from bilateral or multilateral agencies, the borrower will require the state government guarantee. So this is the precondition that is there from taking the concessional loans from the bilateral or multilateral agency by the public sector enterprises and such. Now coming to the GRF, that is the Guarantee Redemption Fund. So this is the last recommendation that has been given. So let's understand this. So this is the this was the reference point that the working group should also assess the adequacy of the state's contribution, that how much the state is contributing to the Guarantee Redemption Fund. So let's see that what the working group has said regarding the state's contribution on the Guarantee Redemption Fund. So first of all, Guarantee Redemption Fund is there to provide a cushion for servicing the contingent liabilities. For servicing the contingent liabilities, that is the potential liabilities of the state government. So Guarantee Redemption Fund has been built that whenever the state governments are in the precarious kind of situation, that they have to give, like the state guarantee, they have to actually pay the loan because the borrower has defaulted. So they have to service their contingent liability, they have to pay their contingent liability. That is arising from the invocation of the guarantees. Now the guarantee has been invocated, the guarantee has been called out. Issued by the state government in respect of the bonds and other borrowings by the state level undertakings or other bodies. So when they have to service the contingent liability, suddenly a massive amount of burden is falling on the state governments, then they can use this Guarantee Redemption Fund to get some part of the money so that they can pay the entity lender easily. Okay. Though the participation from the states in GRF is voluntarily, so you can states can voluntarily participate. 19 states have already established GRF. The GRF is the corpus that is managed by the Reserve Bank of India. It stands at rupees 10,839 crores, and these are the states, these are like 19 states are there that are actually participating in the 19 states are there that are actually managing the GRF, that is the Guarantee Redemption Fund, from which they can take out the money when they have to service the contingent liability and they are in a precarious kind of situation. The GRF is being maintained with the Reserve Bank of India. So here you can understand that the GRF as a percentage of the guarantee outstanding. So out of the total guarantee that is outstanding, the percentage that is kept in the GRF in the 2021 is only 1.1%. That is, out of the total guarantees outstanding, only 1.1% can be serviced through the GRF. That is a very less percentage. Okay, so it has been said by the working group. It has been said that as the quantum of outstanding guarantees are increasing and they are substantial now from the 2017, like from the financial year 2016-2017 to the financial year 2022-23, that is financial year 23, there is 17% growth that has been seen in the guarantees and they have been increasing very fast. So as per the quantum of outstanding guarantees that now compares sizably to the state's existing debt stock, there is merit, there is benefit in increasing the size of the corpus under the GRF by the member states, which is only 1.1% of the total guarantee outstanding. Okay, states should continue to build up the GRF to a desirable level of 5% of their total outstanding guarantees over a period of 5 years from the date of constitution of the fund. Okay, so this is the idea that they should at least, each state should at least manage 5% of their total outstanding guarantees over a period of 5 years. They should be doing this, apart from serving the purpose for which the GRF is maintained, or apart from serving the purpose that it is servicing the contingent liability in the precarious kind of situation, in the situation that has came to the state government suddenly, that suddenly the borrower has defaulted. Now the burden is on the state government. So apart from servicing the purpose for which the guarantee redemption fund has been constituted, the GRF is very beneficial, because maintaining the GRF with the Reserve Bank of India is advantageous for the state governments, because the state governments can take the money. So let's understand this. For the states, as they are entitled, state governments are entitled, if they are managing the fund with the Reserve Bank of India, they are entitled to avail the short-term funds from the Reserve Bank of India under the standing deposit facility at a under SDF, means that they will not have to give any kind of collateral, because they are managing a fund with the Reserve Bank of India. So under the SDF, like when the RBI is taking the deposits, RBI do not give any collateral. Similarly, when the government is taking the money from the RBI for the short-term funds that the government is taking from the RBI, the state government will not have to give any government securities, any collateral. So that's why it is under the SDF, because under the repo rate, the collateral has to be given, but under the SDF, there is no collateral that has to be given. So the governments can avail the short-term funds from the RBI under the SDF at a concessional rate for meeting, that is concessional rate is lower than the repo rate, for meeting the temporary mismatches in their cash flows. The group therefore recommended, the working group has recommended that all the states which are currently not the members of the GRF should consider becoming the members. And you can understand this is the situation of the state governments. They are borrowing from market 78.1% to cover up their fiscal deficit. What is fiscal deficit of the states? So states' gross fiscal deficit is actually the total fiscal deficit of the states. That is the total expenditure minus the total receipts excluding borrowing. So total expenditure of the state governments is way more than the total receipts of the state governments, that is excluding borrowing. So now they are borrowing to cover this total expenditure up, and they are borrowing in the market. 78.1% of the fiscal deficit is being covered by the borrowing from the market, and from the market when they are borrowing, they have to give very high interest rate. So if they are managing the fund with the Reserve Bank of India, against this fund, they will be getting, they are entitled to avail short-term funds that is at concessional rate, at very lower rate than the repo rate. Like previously there was the data that it was the concessional rate was actually lower than the repo rate by 2%. So if the repo rate was 6.50%, the concessional rate will be 4.50%. That is way lower than the market borrowing rate. Okay, so this is the whole scenario, this is the whole understanding. I hope you have got it. It has been a lengthy session because of the report, but everything clear? Any point that you want me to repeat? Any point that I should repeat? Clear till now? Market borrowing from the market, when the states are borrowing, it is at a very high interest rate, at a market interest rate that is 11%, 12%, 10%, maybe 8%. But with the RBI, when they are borrowing from the RBI, when they are availing the short-term funds from the RBI against the GRF, the short-term funds are at the concessional rate, which as per the previous data is lower than the repo rate by 2%, that is by 200 basis point. 2% means 200 basis point. Okay. Working group means that is working for a particular purpose. Okay, so the working group has been constructed, has been made for the purpose of the report and providing the recommendation for the state government guarantee. So that is a working group. A group has been constructed to work on a particular purpose. Okay, for a particular purpose. You're most welcome, Sid. And now let me show you the questions for today. So this is the first question. I hope you will be easily able to answer this question. This is an important report because first time the government state government guarantees has been called out, and they have been like recommendations have been provided for them. So this is the first question. I hope you will be easily able to answer this question. And this is the second question. In the RBI Grade B examination, such lengthy questions are coming. So you should be able to read it fast and answer this. Okay. So these are the homework questions. I hope you will be able to answer these homework questions. So now before going, there is a big announcement from EduTap that we have brought for you the comprehensive guidebook for RBI, NABARD and SEBI, so that through a single guidebook you can get the information regarding the syllabus of the examination. You can get the information for the sources from where to prepare, as well as you can also get the previous year questions with this guidebook. This is absolutely free of cost to save your time, to save your efforts, and you can easily download this guidebook. The link is provided in the description box below. So thank you very much. Do give me the homework answer in the comment section, and if there is any query you can write in the comment section, as well as do tell me that did you like the session and should we bring lengthy sessions for the reports. Okay, so thank you very much, and you can mail us here, you can call us here also. We will connect with you, as well as do comment down below if you liked the session, and do give me the right answer.